Hello all, welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. NYSE floor, of course, is temporarily closed, so we are coming to you remotely on a very big day for the ETF industry. That's what we're going to talk about. Joining me now is Dave Nadig from ETF Trends, Todd Rosenbluth, Director of ETF and Mutual Fund Research at CFRA. Let's start off with this bombshell announcement from the Federal Reserve, Dave, not just buying treasuries and mortgage-backed securities, but also buying corporate bond ETFs. That was a surprise. What does this mean for the ETF community, Dave?
Well, obviously, it's a good thing. It puts some buying pressure under what has been the most pressured part of the market. As much as we've been talking about what's going on in equities, what's gone on in bonds here is really unprecedented. And so seeing the Fed make this move is also unprecedented, but not necessarily unexpected. After all, we have plenty of examples of other central banks doing things like this. The Bank of Japan has been steadily buying ETFs in that market for going on 6 or 7 years now, to the point where they now own 80% of the issued ETF assets in Japan, about 5% of market cap. Now, most of that's been focused on equities, but I think we'll see something like that here in the U.S. My hope is that they participate broadly in the market, not just in ETFs, but across the bond spectrum.
Well, that's a good question, Todd. For example, I mean, it certainly wouldn't be a great idea, I would think, for the Fed to just simply start buying corporate bond ETFs like the LQD. I mean, there is the question of the underlying assets, right? I mean, should the Fed also be paying attention to what the prices of these bonds are underneath it? I mean, it's the mechanism here and how they're doing it that I'm not quite sure of yet.
That's a great point, Bob. So what we have with ETFs, as most viewers know, is that an ETF has a price that it trades intraday, and then there's a net asset value, the value of those bonds inside. And so what the Fed appears to be doing is not only offering a bid or putting a bid for the ETFs, but more importantly, for the bonds that will often be inside the ETF. Corporate issuers and investment-grade corporate issuers like AT&T and JP Morgan, Bank of America, those are widely held within LQD and other investment-grade corporate bonds. If you put too much pressure on the price to drive that higher and not similarly on the net asset value, then you'll see a premium, which is, of course, the opposite of what we've been seeing in recent days and weeks, where we've been seeing a significant discount to net asset value. The bonds inside are not trading, and thus they're impacting the way that ETFs are being priced.
So, Dave, let me go back to my first question. How does this change the ETF community? We now have the federal government, we have the Fed, essentially, as a competitor for certain ETF asset classes. I'm philosophically trying to figure out what that means. I know Japan's been doing it for years, and they've also been buying equity ETFs. That's not happening here yet. But you want to ruminate on what that means for everybody? It's a bit of a different change of mindset.
Yeah, I mean, it is unprecedented for the government of the United States to own the corporate debt obligations of the private enterprises in this country. That is new territory. Now, short term, of course, we know what this means. Buying pressure that'll bring up the price of the ETFs. Hopefully, it will also mark the price, as Todd was saying. It'll help mark the price of some of these untrading bonds if they go out and start being the buyer of last resort there. They're still going to be at pretty low prices. Now, I think it's important to point out the initial facility that they're putting in place to make these ETF purchases has some limits. So it's not like they can all of a sudden own the whole bond market. They're limiting themselves to a fairly small percent. I think it's something under 20% of the existing issuance of any one of these securities. So they're not going to become a dominant player. And I think that's an important point here. We're collecting a bunch of assets, presumably for a short term, much like we did with TARP back in 2008, 2009, right? That was, again, the government stepping in to own assets they don't traditionally own.
And if I can just add to that,
presumably for a short term, you're right, Dave. It says the facility will not purchase more than 20% of the assets of any particular ETF. But I wonder if that's comforting at all. Has the Japanese given back any of the ETFs that they now own? I don't think they're sellers of any ETFs, are they?
Well, what they've done is they've actually made them available for loan. And that was a fairly recent development because they now own about 5% of the market cap of every company listed in Japan. We're a long way from anything like that happening in the US. Although certainly I think what we're talking about, some of the buybacks on the equity side, that's going to start looking pretty similar, like the US, and that means me, a taxpayer, is going to have a share of these giant corporations. So I do think we're headed for something like that. I don't think it's going to be a long-term buy and hold position, kind of like what we've seen in Japan. Japan doesn't show any signs of really unwinding that. I suspect this Fed facility is going to be much shorter term.
Todd, you were going to say something? I'm sorry, interrupted.
No, it's okay. I was going to say that because there is a 20%, they don't want to own more than 20% of it, and they've put in a dollar amount of what they're prepared to spend for both ETFs as well as corporate bonds. You really have a handful of these corporate bond ETFs. You mentioned LQD. I would put some of Vanguard's suite of products like VCIT, that's Vanguard's intermediate term corporate bond ETF. Those are $20 billion or plus assets under management products. Your more $1 billion or perhaps even lower corporate bond-oriented ETFs from various other providers just won't meet the threshold. You know, the Fed doesn't want to move. They don't want to own too much of it, and it probably isn't worth their time to be owning $100 million worth of one ETF and $100 million worth of another ETF. And so this is.
So what are they going to do? Just buy all? It's iShares and Vanguard that sort of control a lot of this. So you're suggesting that the Fed's basically going to buy a small group, a small fund family group, maybe Vanguard and BlackRock, for example.
Yes, this is likely to be in iShares, Vanguard, and even State Street. You know, some there, but to a lesser extent, some of their corporate bond ETFs are $5 billion or higher in assets under management. I would repeat what Dave said. This is likely to be a short-term phenomenon, but it will help all the other corporate bond ETFs if they're buying the underlying bonds of AT&T and JP Morgan and Coca-Cola. That helps the securities inside the portfolio, which will help to bring the net asset value back to more of a stabilized level for the foreseeable future.
Yeah, and I want to emphasize, Bob, we're talking about corporate bond purchases. There is no talk of the Fed buying equities or equity ETFs. Is that correct, gentlemen? I just want to clarify that for everybody.
That at the moment, this is all part of this special corporate credit facility that they're standing up. But look, I think all bets are off, right? Major policy changes are happening day by day here. Things we never thought we'd see in our lifetime are getting dropped every 24 hours. So at the moment, this seems like where the line in the sand has been drawn. I think it's really important to understand this is not the federal government going to buoying the entire market necessarily. They're explicitly not going to be buying ETFs that come up at a premium. So if they manage to sort of reestablish equilibrium in the market, theoretically, that stops the purchase. And then the market can go back to resetting prices. This really ideally would be mostly an open market activity in the corporate bonds themselves. I think they're talking about ETFs here really just to help give some comfort to folks who are in that highly liquid ETF market.